half of that $6,000 if you're trading the mini contract. So that's a pretty decent amount of money when you're talking about trading, a market that moves as much as crude oil. Same thing on the downside. You can see that it goes up. You can see that it goes down. And when it goes down, it has a similar type of movement where, in this case, more than $9 or more than $9,000 per contract for a full-size contract. So wide enough swings, plenty of room within those swings in which we can hopefully capture a piece of it, try to find our spot in there at which we can get a piece of the market and move on up. One of the things in looking, and this is what we also try to do when we look at the markets, we're trying to look at some things on the chart that will help us to kind of like have a boundary, some kind of a way within which the market is going to trade. In this particular case, you can see that over a period of time we have lows, and we'll just kind of arbitrarily put the lows in here somewhere 68, 69, somewhere right in there. In any case, when the market drops below 70, at least in recent history, that looks like about as low as it might go, or low as you might expect it to go. And then you have a situation again, of course, at the tops where we have the highs at roughly $87 a barrel. No guarantee that that's going to be the place that stops the move up. There's no guarantee that a move to the downside is going to stop by the lower boundary, but that kind of gives you the general range. But when you look at that range, that's roughly $18, $19, $18,000, $19,000 for the full-size contract, half that for the mini-size. So that's quite a wide range within which to trade. And so we probably are going to try to figure out somewhere in there how to get a part of it, but we can't afford to put a stop, for example, below the range or above the range and let the market swing that far against us. That's just way too much risk, and we're not willing to accept that much risk. So what we're going to do is we're going to turn to the vantage point parameters here, some risk indicators here that are going to be useful, and try to determine exactly what it is, how we're going to be able to determine where to get in and when to get in. The first one we're going to add to the mix here, the vantage point indicator, is going to be a medium-term moving average, a predicted medium-term moving average. And there are a couple of things about the predicted medium-term moving average that are important. When you see that on the chart, I'm sure that most traders, most of you are well aware of what it looks like, the moving averages and some of the indications that you have there, where you have the angle of the moving average, you have the crossover situations, you have those kinds of things that are all important factors in moving average analysis. We're also going to add to that mix a couple of other things. We're going to add another couple of vantage point things. One is a neuro index, and second is the medium-term and long-term predicted differences. Just to give you an idea what they look like in the bigger picture, you will see that on the bottom part of your screen you have a gray line. That gray line is the neuro index. You have a blue and a green line. That's the predicted differences. We want to talk about those for a little bit. Well, we got an awful lot of data to analyze here. What you have here is a general idea now of what the whole market looks like and the trends and so forth, and the fact that we've kind of moved up in a generally up in an overall direction, but within some recent range boundaries. So we're going to cut back our time here on just to get a closer view of what it looks like, and we're going to look at first of all just a 3-month view to see more closely how we would possibly analyze a 3-month view. We're going to shift over here now and try to do a little annotating on this and try to make some marks on here to show some of the factors that we might be able to look at kind of both from a traditional technical analysis standpoint as well as the vantage point indicators. First of all, we need to point out that when we're looking at this market in general, first we have a sideways trend, just kind of get the bigger picture first. You remember that the market went up. We had a situation where the market in February and through April was pretty much up. April was sideways. May was down. June was up. And July so far has been down. That's kind of the pattern that we have seen. We have seen May go down. We saw June kind of move to the upside. And now we are seeing July go back to the downside. So you have this movement, not precisely regular, but regular enough that perhaps we can be able to take advantage of the patterns that we see on the chart, and assuming that some type of pattern like that is going to continue. A couple of things that we're looking at when we look at these indicators on the chart, and the first thing that we're going to be looking at, of course, as I mentioned, is the angle of the moving average. Is it headed down? Is it headed up? Which way is the angle going? That indicates, direction of the market. Secondly, is that relation to the actual moving average. The predicted moving average is the blue line. The black line that you see there is the actual moving average. So what is the relationship between the predicted moving average and the actual moving average? Then you'll see that we have the crossover situations. For example, we get a crossover right here where the predicted moving average, the shorter moving average, moves above the actual moving average, and we have the same type of thing here where it dropped below the actual moving average. Those crossover situations are significant in terms of trying to illustrate where the trend is shifting, where the trader thinking about the market has shifted and is ready to go in a new direction. A couple of other things that we probably need to point out a little bit, and one of the interesting things is you'll see there's a period of time in this frame right here in May where you had, obviously the predicted moving average below the actual moving average. And if you look at it, you can kind of see, well, there probably was a little tightening of it. Hard to detect exactly what that tightening might be and what it might amount to when you look at the chart itself. But when you look down below, you will see the other indicator that Vantage Point has is the predicted differences. The blue line is the predicted medium-term difference. The green line is the predicted long-term difference. That's comparing two moving averages, a predicting moving average and an actual moving average. And it acts as kind of a momentum indicator to indicate where the market is. The trend is either strengthening or weakening. Is it running out of steam? Are we going further down? That kind of thing. So you can see on the chart above, you can see in this vicinity right in here how this kind of was narrowing, but it's more difficult to see that visually than you can see it right here where, after a little dip, the predicted difference, the blue line there, which would be expected to move a little faster than the green line because of the shorter term nature, it starts to move up. That suggests that the move to the downside, the momentum is weakening a little bit, and that the next move is likely to be up or sideways. So you need to keep in mind those predicted difference lines. They're very important. The predicted differences are important mainly because they tend to occur prior to the shift in the actual trend in the actual moving average.